Welcome to Good Money Guide. Today we're talking to Rezaah Ahmad. He's the CEO and founder of WiseAlpha. Now, WiseAlpha is a fractional bond investing platform where retail investors, or rather sophisticated retail investors, can invest in fractions of bonds that have high minimum denominations. So that's generally bonds where the minimum investment or minimum buy size is 100,000 or so. What WiseAlpha does is allows investors to buy smaller chunks of those. So we're going to have a chat with Reza about what these fractional bonds are, what's going on at WiseAlpha, and get his thoughts on the bond market. So Reza, nice to see you again.
Nice to see you, Richard. How are you doing?
Not too bad. It's been a while, hasn't it? I think we've been talking about 5 years on and off.
Yeah, no, the bond market is a big market that needs to be opened up. So there's a lot of work to do on it, but yeah, it's great to be back, and we can have a chat about what's going on in the bond markets, what's going on with WiseAlpha. So just fire away.
So I mean, first of all, how's business? Because obviously, when you started off, rates were quite low, so bond investments were quite attractive. Have you seen a sort of consistent flow of business, or do you find that WiseAlpha is affected by rates out there?
Yeah, so I get this question a lot. We actually find that when yields are high, so in times of market stress, then there's actually a lot more demand, especially from existing investors who want to kind of take advantage of what's going, what's happening. And so, I guess over the last 3 years, 3.5 years since, the whole, turmoil in the markets from the pandemic and, inflation and things like that, you've seen some fantastic opportunities to pick up corporate bonds at equity style yields. And, I would still say that there is a decent opportunity today, in terms of where yields are. So you have large investment grade or crossover, what we call somewhere in between investment grade and high yield type credit-worthy bonds, where the yields are still in the kind of 8-9% range. Give you an example, Ocado, which everybody knows is a large FTSE listed issuer on the equity side. So people trade the equity. The bonds are still yielding 9%, but at one point they'd been yielding 14-15%, and given that bonds are obviously less risky, higher up in the capital structure, more predictable, have a defined maturity date, I think that was a particularly interesting investment. So there's lots of opportunities still in the market, so a lot of discounted bonds. But yeah, I mean, going back to the original question, when yields are high, it's better for us. So when markets are dislocated, that's when you kind of want to, gravitate and increase your allocation towards kind of, I guess, relatively less risky assets.
Right. I mean, it's interesting. I've always liked WiseAlpha because it's got those household bonds that you can't usually buy. I was having a look on the platform earlier, and I think when I tested it, I did a demo of it 5 years ago. Bought some Aston Martin bonds, which was quite fun. But anyway, I mean, things have changed a lot since then. And one of the reasons I thought it'd be interesting to have a chat is because historically, people have only been able to invest in these fractional bonds or get access to these institutional grade bonds via fractional investing direct through your platform. But you recently launched, or are in the process of launching and integrating, a white label service. And for those who don't know, which basically makes you a technology provider for brokers and banks. So
that's right.
Why is now the time? Why is now the time to do that? Are you seeing much more of an interest in normal investors investing in these bonds?
Yeah, I think, certainly the recent, attractiveness of the yields in the bond market has kind of created more of an interest from wealth managers and, institutions, who are looking to, especially those in other countries, who are looking to do something similar to try to tap into this market. I mean, you've seen recently, for example, the British government has, made, giving retail investors access to, primary issuances of gilts as a as a very important strategy for them in order to tap other liquidity sources. And so it's just a general theme to tap into the retail liquidity base on the fixed income side. And so it's one of the things that we decided to do over the last couple of years is to broaden out our strategy to serving other institutions. And so we've been integrating with a bank, which is getting ready to launch its product to the wider market in a completely different jurisdiction where retail investors have never had access to fixed income. The denominations are particularly, a bit of huge barriers, all institutional. And we're also working with wealth managers in the UK. We announced a deal with Titan Wealth to do that as well. And so we're looking to penetrate further into the wealth management space, because wealth managers also have a very tough time accessing the corporate bond market. And, particularly for some of their clients who actually would like to get direct access to corporate bonds, the 100K denominations at the moment, are still relatively prohibitive. So unless you're an ultra high net worth, where you've got, anywhere from kind of 10 million plus, buying a diversified portfolio of corporate bonds will still cost you like, by 30, cost you 3 million quid. And you're not going to invest all of your money in one asset class. So basically you're kind of talk about ultra high net worths who could maybe access it via their wealth manager. But even then the wealth manager has difficulty engaging with the global banks who prefer to, deal with their larger fund clients, like BlackRocks of this world, M&Gs and, the other large players, who the banks have very strong relationships with and large trading flows. So, there's this wealth management sector is an important area for us to branch into. That's what we'll be doing. And obviously banks and institutions, who also have, clients which will come into this kind of area, are also interested in the product as a result. So, and I think, just stepping back one more thing before we go into a different topic, look, there has been this whole, we've been the leaders of this whole democratization agenda for the corporate bond market. I think it's down to some of our efforts, that's kind of raised this on the radar of government and the regulators who are now, you recently just acknowledged the fact that, a lack of access by retail investors has given them, has harmed their, choice in the market. And so there's a recognition that certainly fixed income and corporate bonds are, something they want to focus on in terms of policy. And our agenda has always been to open up the market. And so by labeling our technology, we can actually give that out to other players in the market to broaden that agenda, so that more people can get access. I think that's so as part of that agenda in general, we just want to have more users from different, product providers or brokerage firms, participating in the market. So actually we achieve the ultimate aim, which is the retail investors in the UK and elsewhere, are able to trade in bonds in the same way that you can with equities.
It is that UK investors aren't so interested in bonds because obviously in the US everybody invests in T-bills as a matter of course, and there are a couple of providers sort of stepping into opening up that market. As you said, you were one of the first. It was a unique proposition at the time, when you set it up, and more and more people are moving into it. Why do you think UK investors aren't interested in bonds? Do you think they're seen as too complicated or a bit fuddy-duddy or a bit boring compared to equities?
Yeah, so I think it's almost a bit of a chicken and egg situation. I mean, there is, interest in bonds. It's just that the way the market is developed, it's made it easier to just, invest in a fund, and so, people have kind of, they're missing the opportunity to actually, invest in a different way where you're able to kind of plan, when you receive your money back by looking at maturities of different bonds to invest in, creating a bond ladder, focusing on lower risk investing and income. I think, certainly, gilts have always been popular in the UK, but not as popular as they are in the US. And I think that's partly, again, down to, the government not really making it a focus from a primary standpoint. It's always all corporates and governments generally, tend to prefer the wall of liquidity in the institutional market. It's kind of easier to transact it. In the US, it's been where there's more dynamic capital markets, there's more technology, more brokers who are able to cater for smaller investors. And so I think, it's been more popular, in the US, and certainly also denominations of corporate bonds have been a lot smaller. So I would say roughly half, 50 to 60% of the US market, minimum denominations, in terms of bonds are $2,000. I mean, they still have high denominations on a large, about 50, 60% of the market, $100,000, $200,000 minimum, but there's a bigger choice. So there's generally been more interest in bonds, and certainly bonds are traded, quite actively out in the US. It could be a lot better, obviously. In the UK, I mean, obviously, when you basically have a handful of small issuers on the London order book for retail bonds, it doesn't drive enough interest in portfolio building and therefore taking bonds seriously. So I think that's more the issue. I think it's really a supply issue, which is the problem, and just the number of people in the market who are, offering, the capability to invest in, household names, FTSE-sized corporates, and our solution, obviously the fractional solution is basically the only way to do it right now. Even if there's a greater push, for direct retail bond issuance on, say, the London Stock Exchange, it will take time to build up. And so if you really want to drive investor interest, the way we figured it was that you have to give them choice, give them education. And I think that part of the other problem is also that there's not many publications write about corporate bonds, because it is heavily institutional.
Well, there was one that did, and then you bought it, didn't you?
Right?
that died. There was a very good one that did, and then you bought it, didn't you?
Right, yeah. So
the old fixed income investor site.
Yeah. No, we acquired that. I was having difficulty. We acquired that, and then we brought it into European High Yield Online. So it's an alternative venue. So we're trying to encourage more people to talk about bonds and learn there. There's certainly a huge plethora of information. So anybody who doesn't know anything about bonds, European High Yield Online is the place to go. It has a huge amount of resource, access to education, prices, commentary, on the markets and things like that. And some people there on the platform also contribute some research and ideas and things like that. Obviously, we'd love to get more people talking about bonds and moving out there. But I think one of the biggest things is, the media and the press talking about bonds a lot more. Bonds because, obviously the returns are still very attractive. You can still get equity style returns on quite a few investment grade crossover and high yield issuers short dated.
So do you think there's space again to revisit Bond of the Week and take a look at an interesting LSE listed bond and write something about it? It used to be one of our most popular features back then, the Bond of the Week. And actually, what's really interesting is, saying that UK investors aren't so interested in bonds. There have been weeks, and sometimes, a couple of weeks when our bond brokers section, and particularly gilts, and to a lesser extent recently, the T-bills have been some of the most popular searched articles on the site. Yeah. It's really interesting having for us having such a broad product base where we cover everything from investing to trading to currency transfers, and we can see exactly who is coming to the site after searching what to read what. And whenever gilts and bonds make it into the news, there's a real flurry of people searching for how to invest in bonds, and particularly the gilt. So maybe we'll take a look at bringing back to life Bond of the Week.
Yeah, I think we're very interested in collaborators who want to publish a bit more of their own ideas or research about bonds. So we, if you want to write a Bond of the Week, Richard, or if there's somebody else who would love to do that, then we will definitely do it. We'll host it. I mean, it sounds like a great idea. I mean, obviously, if you come to WiseAlpha, you get quite a lot of information. If you're signed up as a member of our site, we provide some, regular information on bonds out there as well. So I think, I think really, look, the fundamental changes in this market environment are that, it's the first time that interest rates have been so high in a very long time. So when the initial, there was a bit of I guess, a push back in 2007 to get, corporate bonds into retail hands. Unfortunately, the savings rates, or the bank rates that you had, basically went to zero. Obviously with the caveat there was the few years of the financial crisis, which just helped helped institutions get in. But after that, the last 15 years, I guess, have basically been kind of zero money environment, and gilts obviously yielded nothing, so there was no interest. It was all institutional flow, and even corporate bonds, the returns, the yields, the rates of the coupons that were being issued in the market were just super low, but there was still, again, institutional. So now that's changed. You've got interest rates which are high. It doesn't look like we're going to get ever back to the same kind of zero rate environment that we had. So I think bonds are going to be continually interesting going forward. The one thing I always say to people is that today, the one thing you can be certain of is that there's uncertainty. And when there's uncertainty, always shifting your allocation to less risky asset classes is, for many people, particularly kind of the middle to later stage age people, is normally quite an interesting strategy. To preserve capital, to take less risk, but at the same time still generate strong returns which can beat inflation. And the corporate bond asset class is perfect for that. So I actually think that fixed income as a retail investor asset class is going to become much more important over the course of 2024 than people realize, just because the whole nature of the market environment has changed, and because there's so much uncertainty from geopolitical maneuvers which are going on, and other supply constraints, and just generally the way that economy's been managed over the last 10-15 years, which are bringing out more ups and downs, shall we say.
Popular bonds on the platform, if you were to split it between direct retail investors and the business that's referred in from wealth managers, is there a particular asset class or theme that people tend to buy into when buying these fractional bonds?
Well, I'd say that gilts have obviously been very, very popular recently, just because of the inflation uncertainty. People almost, I guess, viewed them as a way to somehow hedge themselves against the low savings rates that were out there. But then on the corporate bond side, I think the bonds which have done particularly well are the ones that people know, and also have offered a yield of over 8%. So people liked, in that inflationary environment, they like those high yields, and certainly, even companies which you previously wouldn't have thought would have offered an attractive enough yield for people to invest in, suddenly became more interesting. I mean, a lot of investment grade issuers were trading at 6 to 8, 9% returns, annual yields, with a highly discounted price. And people who saw that opportunity, actually have made double-digit returns over the last kind of year or so, because the price has moved up as well. So not only did you get the high carry, the high income, you got the capital price move as well. And that opportunity is still there. It's not, it wasn't as strong as it was a year ago, but it's still strong. You can buy, companies like British American Tobacco with a 6.5% yield, enormous cash, focusing on deleveraging, large conglomerate, companies like Ocado, as I mentioned, even, bonds issued by well-known fund managers like Royal London and M&G, pretty interesting, offering 6-7% yields. A lot of kind of tier two bank debt, has been coming at kind of new issuance levels of 8 to 10%. Corporates who are refinancing, yes, it's kind of been small, the number, just because of issuers waiting for a better time in the market to come and issue bonds. But the bonds that have been issued, have been yielding anywhere from an 8% coupon for major financial institutions to 11.5% with, say, LendInvest, which was a retail bond. Refinancing is existing one out there. So these coupons have become relatively attractive and juicy, and I think there's going to be a lot more event opportunities over the next several years, because a lot of bonds are coming due, and many people who issued coupons of 3 or 4% are suddenly finding they have to double that, or add a couple of 100 bips on top. And so
what do you think is going to happen there? Do you think people are going to struggle? Do you think people are going to struggle when they have to reissue those bonds?
Today is going to continue, and what I'm seeing today is that the bottom end of the market, so what we call the triple C end, or the high risk end, where the financial performance of companies is not so strong because of whatever reasons, changes in industry, the recent market environment, just higher amount of leverage on their balance sheets. Those that the riskiest end of the market, which is like the bottom rung of credit ratings, i.e. the kind of triple C, double C, from single C onwards, but triple C mainly. The price of those bonds, have lagged the rest of the market in terms of moving back up to a more normalized return, and you'll see some events there, either exchange offers, restructurings, maybe some really high coupon new issuance if they can somehow afford it, with some non-cash ailment. Those would be kind of interesting for the more, sophisticated adventurous investors. But if you're just a regular retail investor looking for risk reward, right now, kind of short term, when I say short term, I mean kind of short to medium, kind of 2 to 5 year maturity, high yield, in the Bs, is probably a nice sweet spot, because you can still get, 9-10%, and then new issuance that comes out with high coupons is attractive, so it's good to fill up your portfolio there. If you believe that, inflation will come down more aggressively, and there's still, the jury's out on that, because it's not, the market, the environment today is very much geopolitically driven rather than, straightforward, calculation of what monetary policymakers are doing. But if it does come down, then longer dated investment grade bonds could still offer significant capital upside. And so some people, are interested in those types of those bonds as well within their portfolio.
Platform relatively sticky, or do they job about? Because I was having a look at some of the bonds. Some of them are quite a nice discount to par. Do people come onto the platform to try and gain capital appreciation as well, or do you think they're mainly in it for the income?
I think bonds have always been about income, but I think people who have been adding more, realize that the capital discounts are quite significant, and actually, are almost in a sense dwarfing the income that they're getting every year. And so those who are particularly savvy, have made out like bandits, for low risk, and I think, in terms of the product itself, bonds tend to be, a kind of a sticky investment for retail. They're looking to actually make income over a period of time. That's basically why people are investing in bonds. It's kind of a predictable return. You're kind of looking to find something which is a bit juicier than your kind of risk-free savings. To take some risk, generate a higher return, but still receive your money back. That's kind of the mentality. It's not really a trading mentality. I mean, even in the institutional market, where there's lots more trading which goes on, it is, it's nowhere near the type of trading volatility or frequency that you see in the equity markets. But generally, I would say that retail investors are relatively sticky. They prefer to wait for their money to come back.
Well, we'll move on to your top tips for bond investors who want to get started in a minute. But before we do, we must be balanced. Obviously, bonds are great for income generation. They're slightly higher up the cat scale, as you said, but there are risks involved. But as you see it, what do you think is the biggest risk in bond investing for retail customers who are thinking of moving into this asset class versus the traditional putting money in a diversified fund or ETFs or individual shares?
Yeah, so I mean, I think look, obviously, it depends on the mindset of the investor. So always the view of having someone professionally manage your portfolio, gives some people comfort that there will be diversification, etc. But in actual reality, once you start to get above kind of 8, 9, 10 securities in your portfolio, that the level of diversification becomes less important quite rapidly. Actually, that's what academic studies have shown. So as long as you're fairly competent in terms of diversifying, there's no reason why direct investing can be actually a more rewarding way to invest, because you have a lot more control, than if you invest in a black box fund. So I think, and there has been, as you know, over the last kind of 10 years, a much bigger move for self-directed investing. It isn't simply just a rich man's game anymore, and so look, that's obviously why we feel it's also important to educate people as well, give them that opportunity. I mean, if you're going to trade stocks all day, you may as well think about, well, why not have a small diversified portfolio of corporate bonds as well to kind of have the less risky end of your portfolio. But yeah, the risk is really around diversification. But as long as you diversify enough, the risk of loss in your capital, as academic studies have shown, comes down quite significantly after 8, 9, 10.
And talking of education, let's just get your top 3 tips for anyone who's just about to sign up with the platform or is thinking of bond investing. What are the 3 things you would say to someone that are essential for successful bond investing?
Yeah. First, sign up to learn.wisealpha.com so you get free bond education. That's the priority. All the units that we have on there will basically give you everything you need to know in order to get started. We actually have 5 units, which actually get to a very relatively complicated level, where I'm pretty sure some of my colleagues, in the financial industry, don't have that level of capability to get the answers right. But units 1, unit 2, absolute must. It'll tell you about, what bonds are, how they're structured, who are the companies that are issuing them, how do you determine creditworthiness of a company, what do you need to do in order to understand the company's business model? How does the actual financial calculations work? How bonds calculate, yields calculated? How should you think about your potential returns in the future? So most of these products, bond products, they're not just about income. Because prices are all over the place these days. So thinking about how prices can move up can also be an important factor in return. So basically, what I would say is, if you go to learn.wisealpha.com, it's all free. Get everything you need to know. And we're also available to help out. European High Yield Online, it's also a great place, to just pick up some extra knowledge, extra research, find out what's going on, talk to other people.
How's the community? Is the community growing nicely? Do you see a lot of chatter around new issues and what's moving?
Yeah, I mean, people are always interested in new issues that are coming out. I mean, there's not a huge amount in the sterling market right now. The US market's been relatively active. And I think, the way we're broadening our community is to tap into some of the, high net worth investors who are served by wealth managers. and they find this particularly interesting. The more we can do to spread the word about bonds, the education, get people involved, I think that's the key here. Certainly, I mean, there's a reason why we're the only platform in the UK that offers fractional bonds, because it is I guess it's the legislative and regulatory environment has always been quite myopic when it's come to corporate bonds. So, as we white label and spread, and build our community via other networks, I think that will certainly assist. But I think it's a responsibility for everybody in the financial industry, as well as governments and regulators, to think about how they can boost the interest and the uptake and availability of bonds.
Okay. Do you plan to become a trading venue at some point, like a quasi exchange for bridging the gap between? I mean, I know you sort of are at the. I know you are sort of are at the moment. Was that the sort of ultimate plan, to sit in between the bond market and the customers and the brokers?
It would be nice. I mean, certainly if we did it, it would be very successful. We have dedicated expertise in this sector, and we've obviously been operating now for a good while with a strong track record. So a lot of the technology we've built, and that's actually why we've been focusing heavily on the technology. Once you get the pipes into institutions, then it's very high volume, and then that can help you build that type of future trading venue, more formal trading venue type of structure.
And what about the weird and wonderful world of emerging? What about the weird and wonderful world of emerging international bonds? Any plans to list international markets on WiseAlpha?
So we would love to actually do more European, US dollar, bonds. I think it's really just a function of where we operate our clientele right now. It's mainly kind of UK focused. And so, I think it's more likely from some of our partners. I mean, as I said, look, we're building out the product in other jurisdictions. So there's another country which will, for the first time, be able to offer fractional fixed income, for retail investors. In fact, our technology is being, prioritized in the same way that driverless cars have been. I mean, it was one of the two technologies actually that the government there was focusing on. So it is, we are trying to broaden that geographic reach, and also just the ability to access lots of foreign denominated securities. And we realize that there are people even in the UK who would like to do that. It's just a relatively smaller market right now. As that grows, through probably more institutional connections, there'll definitely be, broadening of that type of security offering.
Okay, and let's just finish off with your third tip. We covered two, didn't we? What's your third piece of wisdom for newbie bond investors?
Third bit of wisdom. Well, I would always say don't go for the highest risk elements, or the highest yielding bonds straight away. I would gradually just build your way in, focus on companies that and understand, products you use, from those companies. That way you can basically tell whether you feel that, you have a greater level of comfort about the investment you're making. So it's not all about yield or return or, the highest return. It's also about, investing in companies that and understand. So start off that way. There's plenty of time to get more interest.
Yeah. That's a good tactic as well. I think especially as a lot of people, particularly in the stock market, are investing in all of these companies they know and love, and a lot of them are trading at all-time highs, which is obviously quite a good thing, because sometimes that's quite a good indication that they're going to carry on home. But at some point, the buyers are going to run out. So, I suppose it's a good alternative. If you want to invest in the companies that you love, and you're worried that the ones trading at all-time highs are looking a bit peaky and bubblish, maybe bonds bonds are a good way to get a foot in the door. Well, Reza, thank you very much for talking to us. I'm sure we'll catch up in the future, and look forward to hearing more about WiseAlpha as you go along.
Fantastic, Richard. It was a pleasure to chat today, and we'll catch up again soon.